Billionaire hedge fund manager Chamath Palihapitya has been warning of an economic slowdown. He recently talked about how recent actions by the Fed could be fracturing the entire economy from the inside, with the drop in growth stocks just being the tip of the iceberg, and how the real effects of what is happening around the world with supply chain bottlenecks from shipping and a change in money policy by the Fed won't truly show up in the stock market for several months.
The biggest thing I'm concerned about is when the revenue shortfalls start to hit the companies that are dependent on these supply chains, but you don't actually see their revenue shortfall for a couple of quarters after the supply chain problems.
This in turn could affect the entire world economy and even kickstart the next recession.
The next step beyond all of the supply chain issues could be a pretty bad recession if these companies have all this inventory and they don't know how to get working capital.
So in this video, we'll go over exactly what effect Chamath thinks the Fed's recent actions will have on markets in the long term, talk about how supply chain issues are far from over, and get into the likelihood that we will see another market dip in the next few months. And if you appreciate me synthesizing all this information for you, please just hit the like button and let's get into it. So the first topic of interest for Chamath is the Fed, led by Chairman Jerome Powell. During the depths of the COVID pandemic, the government started printing huge amounts of new money to try to keep the economy going, giving out cheap loans, tax rebates, and stimulus checks like they were candy. But while this seemed necessary at the time to prevent the total collapse of free enterprise in the country, the economy proved surprisingly resilient to the pandemic, with many jobs just switching to remote work and the stock market recovering from its lowest point in March 2020 just 4 months later in July. But the Fed's money machine was already rolling, and they ended up pumping trillions of dollars into the economy. They literally printed 80% of all dollars ever made in the 22 months between January 2020 and October 2021. And since a lot of those stimulus checks went to people who didn't actually need the extra cash, most of that money ended up going into asset prices. That's why we've seen a boom in housing prices across the country, a boom in crypto, and a boom in the stock market, all coinciding with this unprecedented increase in the US money supply. But while asset prices were soaring, the prices of goods and services at first only increased a little. And even when they started to increase more, with the Consumer Price Index reporting that inflation had increased by 6.2% on average last year, the Fed for a long time insisted those rising rates were simply due to bottlenecks in the supply chain caused by COVID. Fed Chairman Jerome Powell went on the record calling inflation transitory on several different occasions, saying that as soon as the initial shock of COVID wore off, inflation would fall back to pre-pandemic levels. But more recently, he has walked back that position, saying inflation is no longer transitory and that it will continue into the near future. But while that might seem like a fairly innocuous position to change, it had reverberating effects that were felt throughout the economy. See, with inflation pushing up the prices of goods and services across the globe, it posed a problem to a certain class of companies. High-tech growth stocks that were valued based not on current earnings, but on their projected earnings in the future were suddenly perfectly positioned for a selling frenzy. Because as the future dollar becomes less and less valuable, the future growth of these high-tech companies also becomes less valuable. A 7% drop in a dollar's value, compounding year over year into the future for these companies, can take a business that's growing at, say, 20% per year and cut that growth nearly in half. Which is partly why we've seen so many high-growth stocks trade down by 40, 50, even 60% over the past few months. But while those companies have already traded down, the rest of the market hasn't yet reacted as strongly, and Chamath thinks that's going to change in the near future. And while you might be tempted to dismiss Chamath's opinion here, he did foresee the drop in these high growth stocks and set up a spread trade to take advantage of them.
I saw that clearly we were going to go through a period where that high growth tech was going to trade down. So I sold some of that high growth tech, but then I also wanted to figure out a way where I could be less exposed to some of that volatility by continuing to hold what I had. And the best way that I figured out how to do that was to do the spread trade.
So Chamath was right about this first impact of the Fed policy on stocks, but let's look at what he thinks is going to happen next. With the Fed now admitting that inflation is becoming a real problem, their next goal is to start reining it in, and there's been some question if they'll be able to do that without crashing the US economy. The Fed's standard playbook for fighting inflation is to raise interest rates, but there needs to be a careful balancing act there. See, if you raise the rates too slowly, you won't stop inflation and people's savings will just start to evaporate. But if you raise them too quickly, businesses might panic, they might stop investing altogether, people will stop spending money, and you could cause the economy to crash. crash. So neither extreme is good. This has led to a lot of uncertainty in the market, which in turn leads to volatility. Chamath called this a frothy market where certain companies can quickly become overvalued and then just crash a few weeks later. Just look at Facebook, who announced their company's name change to Meta in October last year, saw a brief spike in interest from the public, and then saw their stock price drop like a stone once they missed their earnings estimates in the next quarter. Chamath called this out as a specific example of the market changing from one where any kind of growth was rewarded, like the potential of Facebook getting involved in the metaverse, to one where a focus on future growth was actually punished. And he called out a tweet by Gavin Baker, another well-known investor.
And then the third thing was a market observation from Gavin Baker, which I thought was incredibly brilliant. And what he said was, when you see a drawdown, meaning when the markets go down, it'll affect high growth tech first. But he said this key thing, which is big tech will be the last to crack, but when they do, they are going to get shot.
And while the rest of big tech has not yet seen the kind of drop we've seen from Meta, we may have just seen the start of the big tech drop that Chamath is predicting. So that's all on the technology side of the market. But that doesn't mean Chamath only sees the risks among tech stocks. In fact, the risks may be even greater in the rest of the market. The uncertainty around the Fed means it's becoming harder and harder to predict what inflation will look like next year or even a few months from now. But here's the problem right now. When companies have a hard time predicting where inflation is going to go or where commodity prices will go, it makes it very hard to run a business. How much do you charge to sell a computer when you don't know how much it will cost you to manufacture motherboards or source GPUs in 1 year from now? Estimating becomes a nightmare even in the best of times when you're only forecasting out 1 or 2 months, which was around how long it used to take for a factory, usually in China, to produce something and ship it to American companies. But we're clearly not in the best of times where you can buy something and expect it to arrive on time. Have you tried ordering anything from a smaller company that's basically not Amazon in the past few months? It can take weeks or even months for orders to arrive due to bottlenecks in the global supply chain. And companies are having the exact same problems buying the things that they need to run their businesses. The global supply chain took a hit during COVID, with many workers having to pause loading and unloading shipping containers at first. Add on top of this the fact that many people are now spending more money on goods than on services due to continuing COVID restrictions in many parts of the world, and you're perfectly set up for a problem. Ryan Peterson, the CEO of Flexport, which is a freight forwarding and custom brokerage company based in San Francisco, explained the problem pretty well.
Volumes are high, but they're sort of flat. They're over year, they're flat now. And that's what has me so worried here is that you have increasing delays, even though the input's the same. And when you have a complex system where the same amount of inputs coming in, but the delay is getting longer and longer, that's a very worrisome sign.
So rather than things getting better, things keep on getting more and more backed up with the supply chain. In October last year, we saw record high lead times for managers at companies trying to buy raw inputs for their companies. It was taking 92 days for products to arrive. So as these lead times get longer and longer, it gets harder and harder for companies to predict how much they need in order to meet future demand. If they don't buy enough, they'll sell out and their shelves could sit empty for weeks or even months. And if they buy too much, they might run out of money when they can't sell everything. It's like sitting down today and trying to plan out what you want to eat for dinner for a specific Wednesday 2 months from now. You don't know if you'll be particularly hungry or busy or craving some specific thing. You just have to make an educated guess. And with every company in the world making essentially guesses for how much product they need to order, that is going to start impacting revenues. But if a company misestimates and has a revenue shortfall, or they simply can't get their hands on what they need to sell their product, they're basically sitting there burning money while waiting for the next shipment to come in. But as we heard at the beginning of this video,
the biggest thing I'm concerned about is when the revenue shortfalls start to hit the companies that are dependent on these supply chains, but you don't actually see their revenue shortfall for a couple of quarters after the supply chain problems.
So while high growth software stocks might be down today, the whole underlying supply chain system is slowly getting more and more backed up. And that is going to start showing up in other types of companies' revenue reports in coming quarters. So that then leads us to an important question. Are we going to see the market dip again in the coming months? In that same conversation, Ryan Peterson explained that from the time when a factory produced a finished product to when a company could take delivery of it in the US has increased from 50 days pre-pandemic to 150 15 days now. On top of that, we are seeing all kinds of uncertainty over what the Fed is going to do, even from the Fed itself. In a recent press release, they said they intend to start reducing the size of their balance sheet, basically selling off the assets that they built up while pumping money into the economy over the past 2 years. Yet in the same release, they also said the committee is prepared to adjust any of the details of its approach to reducing the size of the balance sheet in light of economic and financial developments. So not only do individual companies not know what the economy is about to do, not only does the stock market not seem to know what it will do, but even the Fed itself doesn't know what's going to happen, and they will need to adjust their strategy as they go. So let's focus on what we do know, sort of a first principles approach. One, we know the supply chain is all kinds of messed up and that shipping times are not going down anytime soon. We know that this makes it harder for companies to forecast demand. Two, we know there is uncertainty around inflation and where commodity prices will go over the next few months. And we know that this also makes it harder for companies to forecast demand. So my takeaway is that any company that is reliant on physical goods over the next few months is going to face the same struggles with forecasting and getting goods to customers. At the same time, there is a group of companies that doesn't rely on supply chains, and that would be software companies. Now, we've seen many companies beaten down by 50% since their highs in November, and with the uncertainty around the Fed, I think we're going to continue to see a lot of volatility in the space. But I also think that these companies' non-reliance on supply chains could be a huge advantage over the coming months. And seeing as they've mostly already all been discounted, I see less downside here than in the general markets. So my personal strategy going forward will be to focus primarily on companies in the software space that have been beaten down by the market and that have limited exposure to supply chain problems. And I don't think that includes big tech companies like Chamath is worried about, since Microsoft, Meta, Apple, and even Google do all have substantial supply chain needs with running their own data centers and selling their own hardware products. But that's just my takeaway, and you may take something totally different from what's going on right now. I'd be curious if you agree with Chamath that the worst is yet to come for many physical product businesses, or if you have a counter argument to what he's saying. Let me know in the comments. Don't forget to like and subscribe, and I'll see you next time.